Hello, friends, clients, and colleagues. This is Richard Siegel with ARQ Wealth Advisors, and today is Wednesday, December 20th, just after the market close. With all the recent market activity in recent weeks, we thought it would be a good time for a brief market update. So with that being said, we'll get into it. We'll first start with interest rates and bonds, and then we're going to talk about the stock market and then our game plan. So first and foremost, you'll notice in the last couple of months that interest rates have rolled over here pretty hard, especially this blue line. This is the 10-year Treasury. And when rates go down, bonds go up. So the question is, why have rates dropped so much so fast? And the answer is that with the recent economic data around inflation, and the Fed has come out and said that what they're doing is working, inflation is being moderated, that they're probably going to lower rates 3 times in 2024. So for now, at least, rate hikes going forward are off the table, and the market celebrated that with rates coming down and bonds going up. You'll notice here that bonds have been pretty much down all year. And literally from the end of October, negative, let's call it 3%, bonds are up 7 or 8% in the last 2 months. So they were getting very cheap and very attractive, and a lot of the returns got pulled forward very quickly. So again, when rates go down, bonds go up. The Fed funds rate that the Fed controls, they've raised rates from basically 0 up to 5.4% over the last couple of years in order to beat down inflation. When you make money more expensive, it's harder to borrow and lend, and that will kind of stifle purchasing, and then prices come down. So it's working, and you'll notice here that the Fed, the blue line, the Fed is estimating that they're going to have to lower rates to about 4.6 by the end of next year, and then 3.6 at the end of 2025, and the long-term target for the Fed is 2.5%. So these rates here are temporary. The green line is the market expectations. That's the Fed funds futures contracts. It's the market betting on what the Fed's going to have to do over the next couple of years to get to the same place, but the market believes they'll have to cut faster. Moving along to the stock market, it's been a really nice market for the last 2 months almost. You can see here that not only has it been great, but the kind of under-owned, unloved areas of the market have really been the big winners recently. You'll notice here, since November 1st, that's really when the market started to go up. This past August, September, October were very weak, about a 10% correction. And that's typical for that time of year. Seasonally, those months tend to be the weakest, and then the end of the year tends to be the strongest. And so far this year is playing exactly according to plan. So you'll notice here that the best performing index in the U.S. market for the last 7 weeks or so has been the Russell 2000. That's small cap stocks. And then comes the equal weight S&P, and then the S&P and the Dow. So it's been great across the board, but really these smaller and mid cap stocks and value oriented stocks have done better. So with this big move in recent weeks, now the issue is that we're getting back to valuations that are not that attractive on the S&P 500. 19.6 times earnings is definitely inflated. Historically, we're closer to 17 is normal. And you'll notice here that we're almost back to all-time highs, which was almost 2 years ago exactly, about 4,800. And back then, the PE ratio was even more expensive, 21.4. How could that be? Well, it's because the price is the same, but the earnings are higher. Stocks have made money over the past 2 years, which brings PE ratios down. So with this big move in the markets in recent weeks, we feel that the S&P has gotten ahead of itself here a little bit. We would not be surprised to see some consolidation, some weakness in the next few days or next couple of weeks. That being said, most of the stock market globally is still fairly valued or even attractive. Mid caps, small caps, value, foreign equities. It's just the S&P really is the most expensive due to those mega cap tech stocks. Today was an ugly day. We think it's profit taking. There was no real bad news here. But the Dow did pull back almost 500 points today, 1.25%. The Nasdaq 1.5%, and the S&P 1.5%. So across the board, some consolidation, some profit taking, most likely. So again, game plan going forward is we're still sitting on about 8 to 10% cash and a money market yielding over 5% risk-free. It's very hard to get out of that type of risk-free investment. The plan is this: if the interest rates turn back up again, that will bring bond prices down and yields up. At that point, we'll take some of that cash and deploy it into the bond market. Going into 2024, because it's been so strong recently, we think the first half of the year might be somewhat muted. Really heading into an election year, it's usually pretty decent, but we think the second half of the year might be better than the first. That being said, the plan for the stock portion of client portfolios would be more heavily invested if and when we see a technical correction, which means a 10% or more pullback in the stock market. So again, bond yields up, bond prices down, deploy part of the cash, and then the rest of the cash when we have a technical correction in the stock market. Pretty typical to have one of those per year anyway, and we'll use that opportunity to get more aggressive. So with that, thanks for listening. Have a wonderful holiday season, and we'll speak to you soon.